Hello and welcome to the Investors Champion podcast. The goal of this podcast is to give you a quick but informative rundown of some interesting topics affecting UK investors and a rundown of the biggest movers in the UK share market, including AIM and some bonkers bargains for you to take a closer look at. Let's get started. Hello Chris, good to see you again.
Hello Lee, nice to be with you on a sunny day for once. Hooray.
I know, at last, some nice weather.
Yeah.
So we've only had to wait till May for it.
I know.
Anyway, we'll get into it. Another jam-packed episode as always, and we will try to keep this one a bit shorter. The last one was 39 minutes. We'll try and get close to that 30-minute mark if we can.
Yeah, good.
FTSE's doing really well. Pandemic era winners. We're going to discuss Zoom, some company news from Disney, Frontier Developments, video game developer, the Brighton Pier Group. That's a new one to me. Thank you for sharing that one.
It's interesting. Small company in the UK stock market, the Brighton Pier Group.
I'm sure many will be surprised to hear that the Brighton Pier Group is actually a listed company.
I think they will. They'll be even more surprised after we've gone over it.
Yeah. And then we're going to finish off with a deep dive into Airbnb. Could Airbnb become the next trillion-dollar company? We're going to find out. Chris, FTSE 100, up over 8% in 2024. Has things changed in the UK economy?
Look, in the context of the FTSE being a terrible performer over the last decade, it was bound to move, and it has started moving. Sunny times as well for the FTSE 100. There's been a decent performance from the likes of Anglo American, which is currently under offer, the mining group. Decent results from BAE Systems and Rolls-Royce. There's increased defence spending, and Rolls-Royce have got a new CEO as well. Then even the banks are perking up. NatWest and Barclays are doing better. One's recovered from its scandal now on the accounts opening. And then we got higher interest rates that are helpful to the banks. I think it's important to put this into context, though. The FTSE should not be a barometer of the UK economy. These are international businesses with huge international footprints that are benefiting from international growth. But yeah, look, my reaction is about time, really. FTSE's performing. And AIM as well. Other markets are ticking higher, which is great news.
What would you say then is a better barometer of the UK economy then? Would you say it is AIM or would it be the FTSE 250, 350?
Yeah, I would say the FTSE 250, the mid-cap index. Some still very big companies there, but you've got a lot more businesses with a home economy focus. If anything, AIM's actually also got a lot of international companies with a lot of international focus. But I would say the FTSE 250 is generally viewed as a better barometer, probably.
Yeah, I'll tell you what, we're going to start introducing how the FTSE 250 is doing then, going forward.
Yeah.
Moving on to the UK economy. UK construction grows. UK construction, it permeates every sort of aspect of our lives, really, doesn't it? Whether people know it or they don't.
Yeah, it does. And by one guide, it's doing better, rose higher than anticipated, which is great news. As you say, look, it encompasses so many aspects, so many skills, services, trades, whether it's financial, construction, manufacturing, the whole gamut. So it is very important. And I'm look at the numbers. It's currently accounts for 5.5% of the UK's GDP. Market size 120 billion. I mean, it's a huge contributor. So if UK construction is starting to recover and starting to hum a bit, good news. Reasons for optimism.
Are we starting to get positive then on the UK economy and the UK stock market?
I've been positive on UK companies for
You're
a while.
always positive.
I think, well, they're so cheap. Some of them are such good value. And look, Investors Champions put out a lot of coverage of UK construction-related companies, whether they're brick manufacturers or Howdens, the kitchen business, lovely business as well. There are a host of really good, interesting companies, particularly in the construction sector, which are trading at rock bottom valuations, and they've been holding up okay. Their balance sheets are okay, and some of them, I think Michelmersh Brick, which is one of our bonkers bargains, is actually in a net cash position, buying back shares, nice niche operator. So yeah, I just think there are a lot of businesses in that sector that are really good value. And you always know it's a sector that's going to recover. It's a cyclicality. And you might have to wait a while. You're never going to get it to perfection, but it'll bounce. You just got to be in there when it does. Because when it starts going, boom, you'll have a real hockey stick.
Speaking of that cyclical movement, the AIM index, back in October of last year, it touched that 700, previously touched 5 times, going back since 2012. Also as well, it's just crossed the major moving averages, which it hasn't done since 2021 as well. So in terms of things looking a bit more
Barometer's guide, yeah.
Yeah, it just adds a little bit of a tick in the box, doesn't it?
Yeah, it does, yeah. It's a supportive facet of it that one should look at. You shouldn't just ignore it.
No, and I thought of it when you mentioned cyclical movement there, because Anyone who looks at a chart of the AIM index can see it's just bounced along for the last 10 years between 700 and the 1100 to 1300 sort of mark.
Yeah, well, it got to the peak in 21. Fortunately, that's when a lot of people, a lot of clients we got as well were encouraged to join as well. And that's the nature of investing. Everybody's encouraged when things are very high and discouraged when things are very low. And it should be the opposite way round often. When all looks doom and gloom, that's when you should really be rolling up your sleeves and looking at businesses and think, wow, this is too good to miss. I should be in here.
Yeah, agreed. We mentioned cocoa a couple of weeks ago. The cocoa price rocketed past 10,000.
Yeah, well, your hot chocolate was getting more expensive.
Yeah.
Or your chocolate, or your Easter eggs, yeah, or smaller.
But there's another one, isn't there, that's just past 10,000?
It's olive oil. Bonkers. At the beginning of 2020, the price was per metric ton was only just over 1,000. Now it's been recorded as $10,000 a metric ton. That's double what it was just 2 years ago, but it shot up from 2020. But yeah, that's unbelievable price move.
Crypto sort of price moves, isn't
Yeah,
it?
forget about crypto. Just do cocoa and olive oil.
That's what I was thinking, yeah. And while we're on the subject of stratospheric moves, but the FT just recently released an article that 1.5 trillion has been wiped off the value of approximately 50 companies from that pandemic era. But the devil is in the detail, isn't it? Because there is a company within those pandemic winners that actually may have suffered more than most, and it may well be looking at a little bit closer, isn't there?
Yeah, Financial Times put out this article, 50 corporate winners from the coronavirus pandemic, lost roughly 1.5 trillion, huge numbers. Again, it was big headline statements. But you look at the details, the losses have come in video conferencing, online retail was driven by lockdowns, and everybody was buying these stocks that they thought were going to be the future. Well, the big one has been Zoom, whose platform we're benefiting from here. It's a fabulous business. Their shares soared as much as 765% in 2020. The stock has now fallen about 80%. That's a $77 billion drop in value. So the value of Zoom has fallen. It's now worth just $15 billion. However, looking at the detail of this is a much better business now than it was back then. And I would say many of us are more embedded to using Zoom than we were. This is no one-hit wonder. And I just feel it's in pretty good shape. You won't believe a business like this, it's even a tech company that many of us use, is now only valued at 12 times its forecast earnings. All right, there's not much growth in there, but I doubt many investors would believe that Zoom, who don't know it, is only at 12 times forecast earnings. And it makes profits. Free cash flow yield. We love free cash flow. That's the business, the cash the business generates after all of its investments is at 7.7%. So the 7.7, that's relative to its market capitalization. And it's got cash of $7 billion. A third of its market cap, more than a third of its market cap is in cash. All right, it's fallen in value. Is now the time to take a closer look at this and think, wow, has this business got a future? I think it's got a future. I'm not a shareholder in Zoom, but it made me think might be worth a closer look at these levels. What's got up its sleeve? It's got our attention, clearly, quite literally. Has it got other offerings to give us that can keep us locked into its system? Or are there rivals to its system that will take us away from using Zoom? I don't know, but it's definitely worth a look. I think Zoom, at the moment, looks like it's here to stay.
Yeah, I was surprised when I said this 12 times earning. You never would have thought that for such a well-known tech company.
I'm trading it almost a value share, 12 times all that cash. It's wow. And it's buying back shares like a lot of businesses, bought back $1.5 billion of shares. Yeah, it's just fantastic. But I think that might be an outlier. A business is now actually that seems to be in better shape than it was in the pandemic, but which is now worth a fraction of its value during the pandemic peak.
Yeah, definitely worth a look. So yeah, sticking with the pandemic, moving it a little bit closer to home, Boohoo, which has just reported results.
It's another business that's lost 80-90% of its value post the peak. 93%, I think the shares have fallen. Online, Fatailer, it's now trying to grow in the US, but even that's been a struggle. It's got the other problem is its reputation isn't great, is it? It had problems with its so-called sweatshop in the Midlands, and now it's worth only 420 million pounds. What's the future for Boohoo? It's tough to see. It's got quite a good platform. It's quite good, got decent distribution, but you've got the likes of Shein from China now that's been taking its business from it and others. So yeah, I was never a fan really. Didn't understand it. ASOS is the other sort of fallen idle from AIM, moved from AIM, ASOS, but ASOS is the other one. But Boohoo and ASOS, what's their future? Will their future come again?
Yeah, I think the barrier to entry into that market is so low. I don't know about yourself, but pretty much every other week I'm getting a new kind of ad in my YouTube feed from a new clothing company that's
Yeah.
offering clothing that it believes is of interest to me, and a new sort of website, a new kind of delivery service that I've never heard of.
It is, yeah, and that you can launch now seemingly and just plug into somebody else's distribution. So
Yeah,
you haven't got to have it all yourself. There are providers of all the logistics bits. You focus on your brand, and
yeah.
it can be plugged into something else, which has made it tough. So it's a struggler. But before we finish the pandemic, there's a pandemic loser winner again. I think we must conclude with, which is
Yeah.
one of our ultimate stocks. It's a constituent of our ultimate stocks portfolio. NVIDIA, chip designer. This was ranked the 54th best performer in 2020 when everybody was playing video games because its main product is chips for sport video gaming. No sooner did those fall out of favor and people didn't need them any, that it found an even better, longer-term application in AI. And this business is now, so for all the trillion losses we've got on the other side, this business has added 1.9 trillion in market value. So again, look at the detail. But this is due to its position in AI, not video gaming. The risk is there a sign here. You've seen how a cycle can change when the euphoria, if euphoria for video gaming AI dies out. Will we see the share price also plummet? It seems to me that it's got a long sort of road ahead for AI.
Yeah, based on historic euphoric rises, one would say that, yeah, it will die off, won't it, at some point? We look through history, there's always cycles of booms. And I'm not going to say it's been a bust, far from it, but we definitely seem to be in a euphoric moment around AI, don't we?
We are. Everybody's talking about it. Loads of people are spending lots of money on it. Well, the big guys are spending lots of money on it. All the big tech groups. People say we're at the early stages of AI, and it's got a lot to deliver. And NVIDIA is the place to be. But yeah, it all depends how far can you look out realistically. It's growing. Its growth is absolutely staggering. But how long will that continue?
When did you add it to the IC Ultimate Stocks portfolio?
In around 2020, I think we had it in. Till
Okay,
2019, 20. So we got in a bit. We saw it then slump. The shares absolutely plummeted at one point. So they rose and then they plummeted. And then we stuck with it and held our corner and they flown back. And it's still a part of the portfolio, although active management, I think, would have seen us take some money off the table, take a bit of profit on it as well.
I'm sure many probably are aware, but for those that are kind of newer to the podcast, it's a model portfolio, isn't it? The IC portfolio. Would you just explain a little bit about the difference, what a model portfolio is?
Yeah. Investors Champion has created 4 model portfolios of preferred stocks, typically equally weighted. And we've got our ultimate stocks portfolio, which seems to be a portfolio of high quality companies. High quality means businesses that are typically quite large. Many of them are international, that have great reliability of income and earnings, that have great margins, operating margins. And importantly for us, very high returns on capital employed. And they typically also operate in have a really incredibly strong market position. They dominate almost their markets. So we have Alphabet, we have Disney as a stock as well. Others that have been laggards as well. But NVIDIA was our chosen chip play, and we liked exposure to the space. We then have other portfolios that have a different focus. We have an income portfolio, which is focused on higher dividend paying stocks, which are all UK businesses, because we're mostly addressing UK investors. The yield on those is over 5%. And then we have another one called a mega trends, which tries to follow trends. It's less active. It's more longer term. That really has been very volatile. We've had some things absolutely fly and then plummet to earth. But the mega trends have got some wackier positions and some unusual companies that you wouldn't think would be necessarily trend setters. So yeah, there are a mix of them. And finally, we have our AIM for income portfolio, which is a higher yielding model AIM portfolio. So it only includes AIM, IHT qualifying AIM stocks, and the dividend yield on that is around 5% as well. So those are the people that want to have more income from their AIM stocks. We don't chop and change very much. They're models, equally weighted models that we like to stick to, and when we do make changes, we'll communicate those in some of the articles we publish.
So that's 4 model portfolios there, wasn't it?
It is, yeah. The aim for income one is a bit newer. It hasn't
Right.
been around. Well, it's been around for a year and a bit now, but yeah, it's newer than the original ones.
And one of the companies we're going to come on to now is part of the Ultimate Stocks portfolio, and that's Disney, isn't it?
It is, yeah. Look, we won't get into all the detail, but it's had a lot of problems, hasn't it? And it's spent an awful lot of money on its Disney Plus streaming. It's bought a business in India as well through its deal to buy 20th Century Fox that's sort of fallen foul as well. It had to do an impairment. The Disney Plus thing, it's spent huge amounts and it's not yet profitable. It's just about to turn profitable after $11 billion of spending, Disney Plus streaming. Wow. To my mind, has this been money well spent? Because when all's said and done, the business that is now delivering once again for it is its experiences, notably its theme parks, the original core of the group, theme parks, cruise lines, holiday venues. This is the business that is absolutely flying. It's the business that makes the high margins. It is going back to our ultimate stocks themes. It is the unique part of Disney which sets it apart from everybody else and enhances all its brands. So Disney for us is about experiences, and we're pleased to see that motoring along nicely.
Yeah. So are you quite happy with that being part of the portfolio at the moment, where it is, and what do you see?
It's been a bit touch and go. We're giving it the benefit of the doubt for now. It did very well over the pandemic. Going back, it was a pandemic winner because of its Disney Plus bit, did very well. Then it's had big problems around the shareholder activism, which has brought problems. It spent a huge amount of money defending this activist shareholder. CEO Bob Iger's come back. He was very highly regarded. He retired. He's subsequently come back. But we're giving it the benefit of the doubt. But I think the experience is what it's about. And it'll be nice to see Disney Plus as well stop hemorrhaging cash. And it'll be, importantly, I think from all of our perspectives, I think they've got to focus on their content as well. Yeah. I don't know what you think about that, but this business had brilliant content. Where are we now?
Yeah, this is opinion based, but for me, the content has severely dropped off recently. And I know you mentioned there that its experiences are probably its primary source, but they all stem from the actual content it produces. The parks are built off the back of the content, the movies. But if it doesn't get back to making great movies again, then I do fear that it's going to struggle.
Do as well. I'm a big lover of Pixar. We love it. Our family loves Pixar. The creativity of that business was phenomenal. And there was a sort of declining output in terms of quality, I think. It would be interesting to see if they can get that back on track. Because as you say, they take that theme and they sell it into the parks and everything as well. You buy into the whole thing. Oh, yeah. It's incredible.
From one great movie everything else comes from that, doesn't it? The merchandise, the themed rides at the theme parks. If they can't recapture that again.
Yeah, I hope so. Yeah, I hope so. I don't know why they got distracted to the streaming. Why did they? It was like fear of missing out, I think.
I think FOMO, yeah. Probably FOMO.
Just to be sucked in to spend so much money. It's almost as if there weren't enough other platforms out there.
I think as well, the difference with Disney Plus and Netflix and Amazon Prime, God, there's lots of differences, but one of the key ones that jumps out to me is that Netflix and Amazon Prime, they have the ability to go broad and wide. They can put pretty much any content they want on their platform. Disney has, and I know they've expanded a little bit, but they have restricted themselves to just Disney content, which then meant they had to produce the content to populate their platform, which then diminished the value of the content because they had to produce so much.
Yeah, so they have hurried out the stuff, you think?
So they had to just literally throw stuff out, get it out the door. Whereas someone like Netflix or Amazon Prime, they can just sign a contract with ITV or BBC or any sort of the global sort of providers and say, wow, you've got a really successful show. What was the South Korean show that absolutely went viral?
Squid Game?
Squid Games. Squid Games. So Netflix can host shows like that, which helps its numbers, helps its subscribers, creates retention. Can Disney do that with Disney Plus?
Yeah, I don't know. But they've got to focus on that content, as you say, and make it the highest possible quality.
Yeah.
Because that's their heritage.
For me, it's a company that needs to get back to its knitting, which is content, great content. If it does that, all the rest will
you're right.
follow.
Came across this site, the Disney Food Blog.
Yeah.
This is a lady, AJ Wolf, she's called, and she started the Disney Food Blog. I'd suggest people have a look at it. She set up this business herself, simply reviewing restaurants and the food on offer in Disney parks. There are 9 contributors now she employs for this business. She's not even based in Florida. She lives in Texas. and 900,000 YouTube subscribers. I mean, it shows the power of the brand, doesn't it? Of Disney,
Yeah.
this add-on business,
Yeah.
this is totally independent of Disney.
I love hearing stories like that because she's recognised an opportunity, hasn't she? She's seen massive footfall, lots of restaurants. I'm going to write a blog on the food. So
Passionate users, a bit like football teams, passionate users that will go there and follow her and interested in everything about it.
Yeah, well done, AJ Wolf. Yeah, should we move closer to home now then? International news done. We should move closer to home.
Yeah.
Frontier Developments.
It's a Cambridge-based video game developer. It's doing a bit better than everybody feared. The shares have been, we wrote about it in January, I think December and January. Since then, the shares have really bounced. They've got a long way to go back. They've still fallen 80% of their highs. This was another pandemic winner. Without delving into too much detail, it produces not that many video games. Jurassic World is probably its biggest that it pays Universal Studios for. But the problem with this business is, even at $1 billion, whatever cash it generates, it just plows it straight into developing new games. So its free cash flow over 5 years was only £7.8 million per annum. And you can't have a business valued at $1 billion and over 5 years only generated 7.8 million per annum. It's got to demonstrate an ability to generate consistent amounts of free cash, totally ignoring all the bits about how good well, maybe it does, it actually starts it. It's got to do really good games and enduring games, but without going into too much of the detail of the games themselves, it's just been overspending massively. It's gone in various directions. Hopefully it's refocused. For us, and it quotes, I would implore people to ignore this, it starts quoting EBITDA, adjusted EBITDA. Hopefully listeners by now know how much we dislike adjusted EBITDA.
Yeah.
How can you quote adjusted EBITDA? Remember, EBITDA is earnings before interest, tax, depreciation, and amortization. Our business that barely makes any cash and invests vast sums of cash each year into developing new games can quote EBITDA as just blatantly dishonest. And it needs to start telling us what its free cash is.
Is there any indication that it's got something in the pipeline? Any games that it feels they're presenting that may have some of the success of the past ones?
Yeah, it's just announced a third Jurassic World game, so it's got the rights to that. It's signed a license with Universal Studios, or division of Universal Studios, to release that, and that'll come out in a few years. But again, how much is it going to cost? What's that game going to generate in terms of cash over a long period? That's what we've got to see. The other thing I'd like to see with these companies, a lot of them talk about, and I've mentioned this before, their back catalogue. So their back catalogue of games and how many sales they make from the back catalogues of content. Be nice to know how much they have to keep spending to keep their back catalogue up to date. I don't think it's just a free ride. I think the back catalogue will cost money. But yeah, hopefully there's a bit more to go on it, but maybe it'll tread water for a while because we've had this big bounce.
That information is available, what they're spending on the back catalogue to keep them going?
It isn't. No, not at the moment. No, we need to get it. They don't tell us that specifically.
That's actually quite important information, isn't it, you would think?
Oh, I think it's important. If investors want to understand this business and follow it, I can't see it's commercially sensitive. They need to be a bit more forthcoming in that kind of information.
Yeah. And continuing with the leisure and entertainment theme, I think this podcast episode is quite leisure and entertainment themed, isn't it?
Yeah. I thought it'd be an interesting one. As the sun, with the sun shining, I thought it was good to have a bit of that. Yeah.
Yeah. So Brighton Pier Group, a company that I've learned about today.
Yeah, it's a very small company. Its market cap now is about £15 million. It hasn't had a great time. You can imagine outdoor entertainment over the pandemic wasn't great. And it owns, as the name suggests, the Brighton Palace Pier, which has been around Victorian creation, I think. It's got 5 premium bars. It's got 8 indoor mini golf sites. Mini golf has been popular, and it's also bought something called the Lightwater Valley Family Adventure Park. So it's got all these activities. It's been pouring with rain, hasn't it? So the pier business hasn't been doing very well. The adventure park hasn't had a terrific time either. Bar business has been suffering from the consumer downturn and people not spending much or going out. However, the indoor mini golf's been doing very well. They're typically located in shopping malls as well.
Right.
And clearly there's a lot more space now because there are fewer retail outlets. So I assume they've been getting decent deals. They bought this business a few years ago in the Paradise Leisure, I think it's called, Paradise Island Golf, for $10.5 million. And it had 6 sites. Now it's got 8. And that seems to be making decent money. And what's the beauty of that is, once you've built these things, They don't take much capital expenditure. And also that clearly when it's pouring with rain, they're nice businesses to have. When it's sunny outside, maybe it might be a bit tougher.
Yeah.
But yeah, Brighton Pier Group. My concern as well, it keeps on having to spend a lot of money keeping the pier out of the English Channel and stopping rust and doing a lot of renovation, a lot of capital expenditure for the pier.
Yeah, perhaps maybe not one that'll end up in the model portfolio too soon then.
It's not one for us. We've never invested in it. But again, the shares look pretty cheap. They've been fairly battered. And if there is an uptick in the weather improves or its core assets, and if the mini golf keeps going, maybe they're going to use their cash as well to buy other sites to have a more balanced offering. Yeah, I think it's probably worth more than 15 million quid. It's got tangible assets of just over 10. So yeah.
The leisure golf is an interesting one, isn't it? Because as you say, the capital expenditure is quite low. And once you've set it up, 1 or 2 staff to run it, probably at the most.
Yeah, probably not a lot. Yeah, probably not a lot. And as I say, I suspect they're getting quite good deals at some of these shopping centres. You've got a lot of empty space, a lot of space as well. They're probably crying out for somebody to come in and take over the space.
Yeah, and we're going to finish off the episode with a deep dive into Airbnb and the business model of Airbnb. And this was a company that did suffer through the pandemic, where many thought the company wouldn't even survive, let alone become the $100 billion giant that it now is.
We mentioned it in a previous podcast, and the more I look at this business, it's really just incredible. And bear in mind, it's gone through pretty tough times. In the pandemic, it was in a terrible spot, had to lay off a lot of people, but it's just reported. The US companies, by the way, have quarterly reporting, so that it's never quiet. They're always quarters, they're always reporting quarterly results. And the March quarter, Airbnb recorded revenue up 18% to 2.14 billion. And on that, it made around 200 odd million net income, post-tax net income. However, the real thing about this business, Airbnb, and we've used Airbnb lots of times, it's a terrific platform. It's evolving all the time, loads of new features. It's really nifty, and we've never had a bad experience. Always interesting experience as well in interesting cities. But what's incredible with this is the free cash flow. Can you imagine? We're all paying in advance, often months in advance to rent a place, which is going into their platform. So they're capturing the cash very early. And of that 200 odd million net income, in the quarter, they had free cash inflow of 1.9 billion.
Wow.
I've never seen a company generate 7 times more free cash than it does its net income. Once they've got your income, because you're confident to them, you're happy to pay up front. This is a $100 billion US company. You're happy to give them their money. They've got a lot of their own cash as well. The balance sheets, Fort Knox, they are earning interest on it now. Of their 200 odd million of net income, 200 of it is interest income. So they're earning money on their own cash, but also on your cash as well. It's just a cash machine, but that's not giving out. It's really fantastic.
And how much capital expenditure does this company spend?
Absolutely nothing. They write off everything. So whatever they're putting into their systems is absolute peanuts relative to the money that they're generating, the income they're generating. And so that's, bear in mind, only the cut. When we say they make 2-point-something billion of revenue, that's only their commission. The gross booking value on people booking through them in the quarter rose 12% to 22.9 billion. It's 22.9 billion. They're responsible for quite a
chunk of money. That's a lot of money.
Large amount of money. But it's that cash flow is just tremendous, and that the cash flow model is tremendous. It reminds me years ago when our accounting lecturer, told us what we thought Tesco was, and everybody said it's a grocer or whatever supermarket. And he said, no, it's a bank. It's not. You've got it wrong. It's a bank. You go into Tesco, what do? You pay your cash over, or you pay your credit card. They take your money immediately. When do you think they're paying their suppliers? They're not paying their suppliers that evening or that morning or during the day. They're paying their suppliers in 60 days, 90 days time. So they're holding your cash, aren't they? It's much like a bank. And earning interest. And Airbnb's taken that to extreme. It's not resting on its laurels. It's launched new guest favorites. It's expanding. It's introduced something called its icons, where you can stay in iconic places, and it's doing special events. They had over 500,000 guests stay on Airbnb during the solar eclipse in North America. So people went out on the plane of where the solar eclipse and rented houses, 500,000. They've already got record bookings for the Summer Olympic Games in Paris. They've got record bookings for the Euros. It can benefit from these events uniquely, and its platform's there, which is fantastic. And I've heard a lot of people are booking now for 30 days. People are taking their laptops and going to, oh, that's a nice location. I'll work from there for a month. They're going out and renting a house through Airbnb for 30 days.
Yeah, an after effect of the working from home. Also, we mentioned earlier, didn't we? There's no real sort of capital expenditure on it, but the marketing budget is...
Yeah, like a lot of travel-related businesses, they spend a lot on marketing. So I think 25% of their income. So in the last quarter, they spent, I think, $500 million on marketing, 25%, nigh on 25% of their income, which is pretty chunky. And that's the nature of the beast. We've mentioned it with Hostel World as well, another hostel online travel platform. Booking.com is similar, but you can see the benefits once you get people signed up and give them, the key here is giving them a really good service.
Good experience.
Absolutely key. You've got to focus on your service and good experience, and then word of mouth as well then helps. So your marketing costs drop. But yeah, they're spending an awful lot of money on marketing.
Do they pay a dividend as well?
They don't know. They're using a lot of the cash, the free cash, to buy back shares. Some of those shares are issued to cover stock issuance, share-based compensation, but a lot of their cash is being used to reduce their share count. So the remaining shareholders, those that don't tender their shares, don't have their shares, earn more of the business.
Do you think that's a good use of the capital?
I've always had mixed views. I think it needs to be done in a disciplined way, and I'm not sure willy-nilly, perhaps as they are doing it, that it's the right necessarily approach for it. Their shares also look quite high. A lot of people ignore where their shares are and they just go through with buybacks, whatever, the shares are high or low, but I think that needs to be disciplined. If your shares are pretty richly valued, and their shares are quite richly valued, is now the time to be buying back too many shares.
Do you think that this could become the next $1 trillion market cap company, joining Apple and Microsoft? And
I must admit, it's hard to consider that, but it's operating in a very big sector. It's still run by its founders, who are very nimble. They changed tack very quickly over the pandemic. Just before the pandemic, their business was structured very differently, and they've collapsed everything and simplified it. So that founder an entrepreneurial drive is amazing to change things. That's great about smaller companies. So this is a big company that's still operating now like a smaller company. And you can see by all these new initiatives how its market can expand. Conceivably, it's still in its infancy. There are still loads of properties, loads of hosts, as they call them, to find. Loads of people may want to rent out a bit of their houses through Airbnb. And I think that it's reliable as well. I think that's a key thing. You can trust it. You can often trust. I'm sure people have bad experiences, but by and large, the hosts that are on have been vetted now. They've dropped out a lot of the performers and places that weren't up to scratch. And I think they dropped 17,000 properties out, something like that. So you've got a very reliable platform now, and the more reliable, people are happy to pay their money for it in advance.
I guess circling back to the $1 trillion question, the companies that have managed to achieve that have managed to take their core product and then branch off multiple income streams. Apple is perhaps maybe the master of that. We mentioned Disney, didn't we?
Yeah.
Their core product is movies. And then we look at what they've created off the back of the movies, the parks, the cruises, the merchandise. Microsoft, with all the different revenue streams that's produced off the back of its operating software. I guess for Airbnb to achieve that $1 trillion market cap, what the income streams can they replicate off the back of what they've currently got off the platform?
Yeah, I think it's a good point. Microsoft has more recently just acquired its way. It's acquired so many businesses with LinkedIn and whatever. It's just made so many Apple's done a lot of it internally. But you're right. The key with Airbnb is when it's captured your confidence and offered a good service and a good experience. It's a part of the way there, isn't it? What more can it offer you as a user, as a traveler, for starters? And that market alone is vast.
Of course, yeah.
So, yeah, you've got seemingly a pretty good opportunity. And again, going back to it, you've got visionary founders who are flexible and open-minded and aren't probably too eager to screw as well. They can achieve a great deal. And these guys are still in place, aren't they? And they've proven themselves. I think it's an exciting one to follow. Got loads of cash.
Yeah. It's like Zoom as well, isn't it? Zoom, as we've discussed earlier. They've got our attention. What else can they offer that can further boost their revenues and ultimately the share price? So
yeah, and it's an interesting conclusion, that, isn't it? You've got Zoom, a business that boomed in the pandemic, Airbnb, a business that plummeted. A lot of people thought its business was over, Airbnb, and they thought Zoom was going to be the next, I'm going to say, Nvidia. And now you've seen this reversal of valuations and share prices, but both of their companies' business models look pretty good to me.
yeah, and on that note, shall we leave it there?
Yeah, good stuff.
Thanks, Chris. Another great episode.
Thank you.
Well, that's it for today. Please subscribe for next week's episode as we will once again discuss global events, the UK share market, and some more bonkers bargains for you to take a closer look at. If you want to take a deeper dive into any of these topics and indeed more exciting and interesting companies, then please feel free to visit investorschampion.com to learn more. All the links are just in the show notes just below. Many thanks for listening, and we hope you have a great day.